The investment strategies of an individual or company can shift over time, depending on changing circumstances. One strategy that many experts agree is a constant is diversification. Research has shown that while diversification does not insure against loss, diversified investors are more likely to reach their long-term financial objectives while smoothing out at least some of the volatility that is an uncomfortable fact of life in the financial markets.
When you deal with clients and their private wealth and they look forward down the road, one of the most important things that you can do is to understand what the client needs are and what their end goals are. And once you've accomplished sort of the outline of what their monies look like, then you start to layer in diversification into their assets. By diversification, you'd go from cash to treasuries to bonds to equities to international stocks and so forth. And so you really have to understand, and it should be driven by what the client's needs are.
With 22 years of industry experience, Rebecca Rothstein and her skilled team focus on advising high net worth investors on their current and long-term needs. A managing director in the Morgan Stanley Smith Barney Beverly Hills branch, Ms. Rothstein focuses on estate, tax, and financial planning. She also works extensively with corporate officers and directors regarding liquidity and diversification strategies.
The benefits of combining asset classes in a portfolio help to increase performance while decreasing volatility. In up and down markets, riskier assets can help you capture profits and gains, and safer asset classes can help you buffer in down markets to decrease volatility. This can be beneficial to an investor because it will protect their investments in down markets and they'll see increased profitability in up markets.
Frequently named to Barron's list of America's top 100 wealth advisors, Ms. Rothstein was also named the #1 woman advisor in America by Barron's 3 times between 2005 and 2009. She says efficient portfolios may be tailored to match the risk and return requirements of different investors, from the most conservative to the most aggressive.
When you sit down with a client, the most important thing that you have to do is to understand who your client is and understand what their needs are. It's not your money, it's their money. And in order to do that, we do a very detailed assessment of who the client is and where they've been in the last several years and where they are on their road to succeeding in their own financial planning. To do that, we sit down and we assess all of the assets that they currently own. Nobody comes in to see us that doesn't have a portfolio of some kind that may include stocks, bonds, 401ks, real estate holdings, and things like that. So once we understand who they are, we can then assess how volatile their portfolio is and then move towards reducing volatility with the intent of, accomplishing their financial goals. And by doing that, we start to layer in securities that are less volatile and not as correlated to the stock market.
A prudent, diversified strategy makes use of the many different asset categories available to investors, such as large cap stocks, small cap stocks, international equities, and fixed income securities. It's also important to diversify within asset classes by including multiple investment styles.
When you are sitting down with a client and trying to accomplish their financial needs, and depending on where they are in their life, it will become necessary to employ different asset classes in order to accomplish their financial goals. If they're young, they can take a little bit more risk, so you would use asset classes that may have stocks in them. As they move up the age chain, you might just start to add more bonds into your asset allocation. If they're planning for their children, that's a different asset class that you use for those solutions. But a good advisor understands who the client is, what their goals are, and finds the right asset class to accomplish that goal.
Once the available asset classes and investment styles have been identified, investors need to decide how much to allocate to each. It requires careful analysis of both past asset class performance and expected future returns.
When you're advising somebody on how much to allocate in different asset classes, it requires really careful analysis. You need to sit down, you need to do your homework, you need to understand who the client is, and then you need to explain to the client that whatever we put in place today is not set in stone. This is an ongoing work in progress. We sit down in 2012 and you're in your 50s and we establish one asset class, and 5 years later we sit down and maybe we adjust. But between now and 5 years from now, we need to have face-to-face meetings at least once a year, if not more, and figure out where we are in our chain of events to accomplish what your goals are.
More commonly known as ETFs, exchange-traded funds have seen a surge in popularity over the past decade. For some, these investment vehicles may offer significant advantages, such as additional diversification, increased liquidity, more current price information, and improved tax efficiency.
ETFs are the newest asset allocation that we use now. 5 years ago, we had hardly any in our accounts. We would use the spiders, the diamonds, and the Qs. Today, there are hundreds of ETFs that exist in the marketplace that allow us to fine-tune an asset allocation for a client that is inexpensive, very targeted. You can buy them. They range from municipal bond ETFs to treasury ETFs to international ETFs, and there are hundreds of them. New ones come to market almost every day. There is not an asset allocation that I manage today that doesn't have some form of ETF in them. We love them.
Diversifying an investment portfolio involves a number of critical decisions. It's easy to make expensive mistakes. Diversification is also an ongoing process. Investors must constantly evaluate capital market trends to see if changes in their portfolios are needed.
The way that we monitor portfolio performance is by first creating an investment policy statement. What this helps us do is define the client's objectives and the asset allocation for the portfolio. Within the asset allocation, we utilize several different investment securities for the client. Now, these investment securities can be varying in nature between ETFs and mutual funds. We monitor these on a weekly basis, and when we find that these are underperforming against their benchmarks, we take a proactive approach, call the client, and make sure that we suggest a suitable alternative for their portfolio.
Rebecca Rothstein is a seasoned financial advisor. She can help you define and strive to meet your goals by delivering a vast array of resources to you in the way that is most appropriate for how you invest and what you want to achieve. Working together to preserve and grow wealth, you'll have access to some of the world's most respected investment professionals, a premier trading and execution platform, and a full spectrum of investment choices. To contact Rebecca Rothstein, call the toll-free number or log on to her website.